The world is waking up to news about the imposition of tariffs by the Trump administration. This and, of course, other events will shake up financial markets this upcoming week. Thanks for joining us at XM.com. It's the week ahead. I'm Christina Marujos, and with me today is Rafi Boyajian, our lead market analyst. So, Rafi, President Trump announced new tariffs across the globe, and they are likely to cause some unrest not only in diplomatic terms, but also in financial markets. So, how do you think global markets might perform moving forward?
Well, Christina, it doesn't look like this whole trade war turned out quite how many analysts or investors were expecting. The US signed trade deals with just a handful of countries, and it seems like the remaining countries are looking at a minimum 10% tariffs, but some are facing tariffs of up to 41%. So this is still, we're still pretty much in trade war mode. There's the possibility, of course, that some of these tariff levels might get renegotiated, but on the whole, I don't think this is where markets expected to end up. Yes, we are not in the worst case scenario, but neither are we in the best case scenario. And at the end of the day, what we're looking at is tariff levels that are much steeper than where they were prior to President Trump coming into the White House the second time. So we can be certain that this is going to have consequences. Obviously, the immediate impact will be on inflation domestically in the US and how this affects Fed policy. That remains to be seen. But to the rest of the world, I think we are now shifting from that initial assumption that it was the US economy that was going to get the most hit. Now it seems like other countries will probably struggle. Maybe we might end up in a global recession. And we're already seeing global stocks really kind of struggle, on the expectation that, we're headed towards a much weaker growth. In the US, stocks haven't been doing too badly, although it has to be said that much of the gains on Wall Street are being led by the big tech, particularly those that have some AI-related benefits to their earnings. So those are fine, but on the whole, it hasn't been such a great time for equities that we might see potentially the sell-off accelerate in the coming days or weeks. The US dollar has been benefiting because, as I said, is now markets are more worried about how other countries might be affected rather than the US. Still, though, nothing too dramatic for now. Gold, for example, is trading near its recent lows. It hasn't really seen renewed positive momentum. Oil prices have taken a minor hit from the tariff deadline kind of passing and President Trump announcing somewhat higher rates than expected for a host of countries. But of course, should we get any sort of hints in the coming days that maybe Trump is willing to renegotiate, we might even see a bit of a relief rally. But for now, yes, there's the risk of steeper sell-off. But for now, things seem to be pretty calm, given given that this is where we're hoping to end up.
Well, without a doubt, the imposition of tariffs introduced a new wave of uncertainty in the markets. However, staying in the United States, the ISM Services PMI might give us some clues on how the economy has been performing so far. Now, could this data set prove market moving for the dollar?
Well, it may be. I don't think it's going to be nothing too hugely market moving because we have had quite a lot of data already. We saw stronger than expected growth in the second quarter. We saw somewhat hotter than expected core PC inflation. Jobs report hasn't been too bad either. So on the whole, I think we're looking at a much more resilient US economy than what we were expecting just a couple of months ago, for example. So I think the focus with the ISM Services PMI will be on the employment index and the prices index because these are somewhat more forward-looking than the actual data, than the real data. And so any hints that the US economy is starting to struggle or quite the opposite, that actually price pressures are building up, then that's going to further bolster the case of the Fed staying on hold for the foreseeable future. And maybe risk assets might not like that too much, but for the dollar that would be positive.
Now, the UK might be breathing a sigh of relief as it secured a 10% tariff deal with the US a few months ago, but the pound might have an interesting week with the Bank of England policy meeting coming up on Thursday. Now, although the bank kept rates unchanged when it met in June, are we likely to see a rate cut this upcoming week?
Well, Christina, that is the consensus, and it might seem a bit odd that there's strong expectation of a rate cut in the UK, given that inflation actually climbed all the way to 3.6% in June, and this is because the Bank of England is trying to overlook the current upswing in inflation, as they're quite worried about the labour market. We've seen quite a notable deterioration, but even there are some question marks because the UK labour market data has been a bit unreliable lately, so the bank is taking a bit of a risk. But I think the question in terms of reaction to the pound, yes, on the one hand, even if the Bank of England does kind of maintain their gradual, careful approach, I don't think that's going to be a huge boost to the pound because of the fact that the UK seems to be headed towards a stagflationary situation where growth is struggling and inflation remains sticky. I think that though, should we see potentially a tighter vote than expected, for example, in the previous meeting that they cut rates in May, in fact, there were some members who preferred a 50 basis point rate cut. So if we get a three-way split now, I think that's likely to be somewhat more negative for sterling rather than should we get a two-way split where actually maybe it's a 5-4 vote and Governor Bailey has the casting vote to cut rates by 25 basis points. So a tight vote might be somewhat supportive for sterling. But on the whole, despite that relatively favorable trade deal with the US, things are not looking too great for the UK because of the Labour government's handling of their economic policies.
And finally, Rafi, let's look at the yen. It's not exactly having the best of times. It took a hit after the Bank of Japan signaled that it's in no rush to hike rates. And of course, the Japanese currency also plummeted to a 4-month low against the dollar after the tariff announcements. Could the summary of opinions and wage growth data offer the yen any support?
Well, it is possible because I think we've seen this before, that markets always seem to underestimate the Bank of Japan's commitment to normalizing policy, to raising interest rates, and markets aren't really convinced that we will get a rate cut later this year, although there's a good chance of that. I think we've had decent basis points being priced in following that US-Japan trade deal, but there is some skepticism, and the Bank of Japan, they haven't strongly hinted at a rate cut. They've obviously hinted that now it is more possible than it was before that trade deal with the US, but there are still some doubts. So maybe the summary of their July meeting, it might reveal a little bit more about number of participants wanting to raise rates again later this year, and also potentially should we see some pickup in wage growth as well, that could also ratchet up expectations. But what's kind of unusual for yen is that it hasn't really benefited from the trade war at all. I guess mainly because concerns domestically, not just the economy, and also but some political issues as well in Japan, where Prime Minister Ishiba is under pressure to resign.
I see. Rafi, thanks so much. This was The Week Ahead at XM.com.